Imagine a single financial entity controlling more wealth than the entire GDP of countries like Portugal or New Zealand. We're talking about hedge funds, the secretive, often misunderstood titans of the investment world, collectively managing trillions of dollars. But what exactly are these behemoths, and how do they wield such immense financial power? By the end of this video, you'll understand precisely what a hedge fund is, how they generate their colossal profits, and sometimes catastrophic losses, their controversial fee structures, and why their impact reverberates across global markets, whether you're an investor or not. Get ready to pull back the curtain on one of finance's most exclusive clubs. At its core, a hedge fund is an alternative investment vehicle that pools capital from accredited investors, deploying highly sophisticated strategies to achieve outsized returns. Unlike traditional mutual funds, which are heavily regulated and typically only go long on stocks, hedge funds operate with far fewer restrictions. This regulatory freedom allows them to use complex instruments, leverage, and short selling, essentially betting on assets to fall as well as rise. Consider the stark contrast. A typical mutual fund might invest your money into a diversified portfolio of publicly traded companies, aiming to track or slightly outperform a market index like the S&P 500. A hedge fund, however, might simultaneously be long on emerging market bonds, shorting a specific tech stock, trading currency pairs, and using derivatives to bet on the price of oil. Their playbook is vast, unconstrained, and often opaque. The name hedge fund itself is a bit of a historical misnomer. While the original concept involved hedging against market downturns by simultaneously buying and shorting stocks, today's funds often take aggressive, highly concentrated bets that are anything but hedged. Many pursue absolute returns regardless of market conditions, aiming to profit whether the market goes up, down, or sideways. One of their most common strategies is long/short equity. A fund might identify a company they believe is undervalued and will rise, a long position, and simultaneously identify another company in the same sector they believe is overvalued and will fall, a short position. This aims to profit from the relative performance of the two companies, rather than the overall market direction, although directional bets are also common. Another powerful strategy is global macro, where funds make bets based on macroeconomic trends, such as interest rate changes, currency fluctuations, or political events. Legendary investor George Soros's Quantum Fund famously broke the Bank of England in 1992 by shorting the British pound, reportedly earning over $1 billion in a single day. This wasn't hedging, it was an aggressive, high-conviction bet on economic policy. Then there's event-driven investing, where funds capitalize on specific corporate events like mergers, acquisitions, bankruptcies, or spin-offs. They might buy shares of a company being acquired, anticipating a higher payout, or invest in distressed debt of a company undergoing restructuring, hoping for a turnaround. These strategies require deep fundamental analysis and often a long investment horizon. But here's where it gets interesting: all this sophisticated strategy comes at a price, a very steep one. Hedge funds are famous for their 2 and 20 fee structure. This means a 2% annual management fee on assets under management, AUM, plus 20% of any profits generated. So, if a fund manages $1 billion, it collects $20 million in management fees, regardless of performance. If that fund then generates a $100 million profit, it takes an additional $20 million as a performance fee. This fee structure heavily incentivizes managers to seek high returns. While the 2% fee covers operational costs and provides a baseline income, the 20% performance fee is where managers make their fortunes. It aligns their interests with those of their investors. The more profit they make for clients, the more they earn for themselves. However, it also means investors need truly exceptional returns just to break even after these hefty charges. With such high fees, who exactly gets to invest in these funds, and why would they choose to? Hedge funds are generally reserved for accredited investors, individuals with a net worth exceeding $1 million, excluding their primary residence, or an annual income over $200,000, and institutional investors like university endowments, pension funds, and sovereign wealth funds. Minimum investments often start at $1 million, sometimes reaching $10 million or more. These sophisticated investors seek alpha, returns generated by a manager's skill, independent of broader market movements. They use hedge funds to diversify their portfolios and gain exposure to strategies unavailable in public markets, aiming for uncorrelated returns that can perform well even when traditional stocks and bonds struggle. For large endowments like Harvard or Yale, hedge funds form a significant portion of their multi-billion-dollar portfolios. But with great reward comes great risk. Hedge funds' aggressive strategies and use of leverage can amplify both gains and losses. The collapse of long-term capital management (LTCM) in 1998, a fund managed by Nobel laureates, required a $3.6 billion bailout orchestrated by the Federal Reserve to prevent a wider financial crisis. More recently, Archegos Capital Management, a family office operating like a hedge fund, defaulted on margin calls in 2021, causing over $35 billion in losses for major global banks like Credit Suisse and Nomura. These incidents highlight the double-edged sword of hedge fund power. Their substantial capital and active trading can improve market efficiency, providing liquidity and correcting mispricings. Yet, their concentrated positions and interconnectedness with large banks through prime brokerage relationships can pose systemic risks, threatening the stability of the entire financial system when things go wrong. They are not merely participants, they are often the market architects. Ultimately, hedge funds represent the cutting edge of financial engineering and active management. They are exclusive, highly compensated, and largely opaque, operating in a world of trillions, constantly seeking that elusive alpha. They are a powerful force, capable of both incredible innovation and significant disruption, shaping the global financial landscape in ways most people never see. The question isn't just how much money they manage, but whether their pursuit of outsized returns ultimately serves the broader economy, or simply themselves. If you're curious about the ongoing debate between active and passive investing, click the video on your screen right now to dive deeper into that discussion.